Hello, and welcome back to Financial Market Insights for Traders. I'm your host, Sophia, and today we're diving into one of the most important and fascinating forces shaping global markets: sector rotation. You've probably noticed it before. One year, technology stocks are the darlings of Wall Street, growing faster than anyone thought possible. Then suddenly, sentiment shifts and everyone piles into defensive utilities, chasing dividends and safety. That push and pull, that constant reallocation of investor money, is sector rotation. And in 2026, it's not just a background dynamic. It's at the center of how valuations are set, how portfolios perform, and how we should all be thinking about risk and opportunity. We're going to unpack the full picture today: what sector rotation really means, why tech and utilities are the best examples of its extremes, how stock valuation fits into this story, where opportunities might be in Europe this year, and the classic debate of small cap versus large cap stocks. And of course, I'll be sharing some historical lessons, psychological insights, and practical steps you can use in your own investing or trading. This is going to be a detailed episode, so grab your notebook or keep your app handy for notes. What is sector rotation? So let's start with the basics: sector rotation. At its core, it's the movement of capital between different parts of the economy as business conditions change. Investors don't usually leave equities altogether. They simply adjust where their money is working, depending on growth, inflation, and central bank policy. Think of it in terms of the business cycle. Early expansion: this is right after a downturn. Growth starts picking up, consumer confidence improves, and the big winners tend to be cyclical sectors: technology, consumer discretionary, and industrials. Mid-cycle: growth stabilizes, earnings plateau, and leadership broadens out. You often see healthcare and communication services performing well here. Late cycle: inflation pressures mount, interest rates rise, and growth slows. At this stage, investors pivot into defensive plays like utilities, energy, and consumer staples. And recession: that's when safety dominates. Investors chase stable cash flows in utilities and healthcare, or they hold cash and bonds. Now here's the trick: you don't need to perfectly predict these stages. What really matters is recognizing when capital is already rotating, and then positioning your portfolio early enough to benefit. Tech versus utilities: two opposite poles. Few sectors capture this dynamic better than technology and utilities. They sit at opposite ends of the investing spectrum. Let's start with technology. Technology stocks are the engines of growth. They thrive on scalability and innovation, and they capture investor imagination like no other sector. Think artificial intelligence, cloud computing, digital payments, cybersecurity. These are long-term growth engines that can transform industries. But tech also comes with risks. Valuations often reach nosebleed levels. These companies rely heavily on investor confidence and cheap capital. And when rates rise or when growth slows, tech is often the first to get punished. So in 2026, the big picture for tech is this: demand for AI, cloud, and fintech remains strong. But the real question is whether valuations are justified, or whether exuberance is pushing them too far ahead of fundamentals. Now, utilities. Utilities are steady, defensive anchors. They're not exciting in the traditional sense. They're regulated businesses: electricity, water, gas. Their revenues are predictable, and their dividend payouts are what attract investors. The downside? Limited growth potential. Utilities are capital intensive, slow moving, and exposed to government regulation. But in 2026, utilities are actually more interesting than they've been in decades. Why? Because of the renewable energy transition. Wind, solar, smart grids, and ESG mandates are giving utilities growth angles on top of their defensive stability. So here's the key takeaway: when growth is abundant, investors chase tech. When fear rises, they rotate into utilities. Watching the flows between these two sectors often tells you a lot about broader market psychology. The valuation lens, but sector rotation doesn't exist in isolation. It's always tied to valuation. If investors chase technology at 40 or 50 times earnings, you have to ask, is that sustainable? Conversely, if utilities are yielding only 2% while inflation is at 4%, is that actually defensive or is it just dead money? So let's break it down. For tech, valuation often comes back to price to earnings ratios, which tend to be high but reflect growth expectations. Price to sales ratios, which are useful for earlier stage firms with limited profits. And discounted cash flow models, which are highly sensitive to interest rates. For utilities, valuation is about dividend yield, the central metric for investors, price to book ratios, because these companies are asset heavy, and regulatory frameworks, because government subsidies or rate changes can make or break long term returns. The big insight here is that investors rotating into tech should always test whether valuations are grounded in reality, while those rotating into utilities should check whether yields and returns actually justify the allocation. Europe 2026, best value stocks now. Let's talk about Europe specifically, because this is where the phrase the best value stocks in Europe 2026 really matters. Europe is dealing with slower growth than the US, higher energy costs, and tighter monetary policy. And yes, these are headwinds, but they also create opportunity. On the technology side, Europe doesn't have Silicon Valley giants, but it does have standout niches. Fintech in the UK, robotics in Germany, and industrial automation in the Nordics. Many of these companies trade at lower valuations than US peers. That makes them attractive hunting ground for value-oriented investors. On the utilities side, Europe is at the forefront of the renewable transition. The EU's Green Deal and carbon neutrality targets force utilities to invest heavily in wind, solar, and grid modernization. That means these aren't just defensive stocks, they're also growth platforms for the next decade. So the investor takeaway? In Europe, the best value opportunities in 2026 are a blend of discounted small cap tech innovators and utilities aggressively pivoting to renewables. Small cap versus large cap stocks, let's layer on another classic debate. Small cap versus large cap stocks. Small caps offer more growth and are often under-researched, which means they can be mispriced. They're more nimble and can innovate faster. But they're also more volatile, less liquid, and more vulnerable in downturns. Large caps, on the other hand, are stable, liquid, and institutionally favored. They provide dividends and global reach, but they don't have the same explosive upside as a nimble small cap disruptor. Here's how this plays out in sector rotation. In a tech-driven rally, small caps often outperform because investors chase high growth. In a utility rotation, large caps dominate because they deliver the stability and dividends investors crave. So in 2026, smart investors are blending both, holding small caps for upside and large caps for resilience. Lessons from history, it's always useful to look back. During the dot-com bubble of 1999 and 2000, tech valuations exploded before collapsing. Utilities quietly held their ground. In the 2008 financial crisis, utilities and defensive stocks protected capital while growth collapsed. And during the pandemic rally of 2020 and 2021, tech became the safe haven, while utilities lagged until the recovery phase. The lesson is simple. Sector rotation is cyclical. It always comes back around, and being aware of it prevents overexposure at the wrong time. Investor psychology, we can't forget psychology here. In bullish environments, fear of missing out, FOMO, pushes investors into high-growth tech, sometimes regardless of valuation. In bearish environments, loss aversion pushes them into utilities, even if yields are modest. So rotations aren't just about economics. They're also about human behavior. Understanding both gives you a real edge. How to position in 2026, let's talk practical steps. Watch macro trends. If inflation is easing and central banks are cutting rates, lean into tech. If uncertainty or stagflation looms, utilities become your friend. Blend small and large caps. Small caps for growth, large caps for stability. Don't choose one or the other exclusively. Stick to valuation discipline. Avoid chasing overpriced tech. And don't buy utilities that don't yield enough to compensate for inflation. Tools and resources. And of course, having the right tools makes this so much easier. For a world-class, cutting-edge, user-friendly trading platform app. I recommend checking out crystalballmarkets.com. It gives you the tools to monitor sector flows and act quickly. And if you want to deepen your knowledge with beginner-friendly podcasts on trading, investing, macro, and financial markets, you should definitely listen to Crystal Ball Markets on RSS. Perfect for staying informed while commuting, working out, or even just relaxing. FAQs before we wrap up, let's tackle some quick questions I get all the time. Question: is now a good time to invest in utilities? Utilities perform best when uncertainty rises or when rates peak. In 2026, those with renewable exposure offer both income and growth. Question: which sectors benefit from falling interest rates? Growth sectors like tech benefit most because lower rates make future cash flows more valuable. Question: how often should I rebalance for sector rotation? Quarterly reviews are common, but major rotations happen with business cycles, not weekly swings. Question: are European small caps riskier than US small caps? Yes, because of lower liquidity and fragmented markets. But that also means overlooked bargains for sharp investors. Final thoughts. So here's the takeaway. Sector rotation, especially between technology and utilities, is one of the defining dynamics of 2026. Tech brings growth and innovation, but valuations need to be watched carefully. Utilities bring stability and income with the added bonus of renewable energy growth. Valuation is your compass. Don't chase hype and don't accept weak returns in the name of safety. For those hunting the best value stocks in Europe 2026, the sweet spot lies in underpriced small cap tech firms and utilities investing heavily in renewables. And remember, balance small cap versus large cap exposure to smooth out the ride. The winners this year won't be the ones who chase fads or cling to safety blindly. They'll be the ones who understand rotation, respect valuation, and adapt with agility. That's all for today's episode of Financial Market Insights for Traders. I'm Sophia, and I'll see you next time. Until then, stay smart, stay disciplined, and stay ahead of the market.